Everyone knows Sun Tzu wrote the ultimate guide to military strategy. But what if I told you that the art of war is actually the most sophisticated financial playbook ever written, and the wealthiest people on earth have been using it to accumulate billions while you were told it was just about ancient battles? Here's the disturbing truth. While you're reading generic finance advice about budgeting and index funds, elite investors are applying Sun Tzu's principles to create generational wealth. They're fighting economic wars you don't even know exist. And the reason no one talks about Sun Tzu's financial genius, because scarcity protects advantage. Today, we're exposing what's been hidden in plain sight for 2,500 years. Welcome back to the Economic Philosopher, where we excavate the hidden connections between ancient wisdom and modern wealth creation. Sun Tzu's Art of War, written around 500 BCE, is revered by military leaders, business executives, and strategists worldwide. But here's what's rarely discussed. Sun Tzu wasn't just a military general. He was an economic theorist who understood that war and, by extension, all competition for resources fundamentally an economic problem. Every principle in the art of war translates directly into financial strategy because both warfare and wealth building operate on identical foundations: limited resources, strategic positioning, competitive advantage, and the psychology of decision-making under uncertainty, the gap in our understanding. We've treated the art of war as a metaphor for business, when it should be read as a literal blueprint for financial warfare in markets where your wealth is won at the margins, and every dollar you capture is a dollar someone else doesn't. Today's exploration promises to fundamentally shift how you think about money, investing, and wealth accumulation. We'll journey through 4 dimensions: the historical economic context that shaped Sun Tzu's thinking, the philosophical framework underlying his strategic principles, the psychological insights that make these strategies devastatingly effective, and finally, the concrete economic applications that can transform your financial life today. This isn't abstract philosophy. This is weaponized wisdom for wealth creation. Let's begin. To understand Sun Tzu's financial genius, we must first understand the world that forged it. The Warring States period in ancient China, fl. 475 to 221 BC, was an era of unprecedented economic transformation and brutal competition. 7 major states fought continuously for supremacy. And here's the critical insight. These weren't just military conflicts. They were total economic wars, where victory depended as much on agricultural productivity, trade networks, and resource management as on battlefield tactics. Sun Tzu lived in an environment where economic calculation determined survival. A state that spent its treasury carelessly on prolonged campaigns would collapse from within, even without military defeat. The historical records are clear. More states fell from economic exhaustion than from conquest. Consider Sun Tzu's most famous principle. The supreme art of war is to subdue the enemy without fighting. This isn't philosophical poetry, it's economic optimization. Every battle costs resources, weapons, supplies, soldiers who could be farming. The most economically efficient victory is the one that costs nothing. This same period witnessed the rise of what historians call economic warfare as a primary tool of statecraft. States would flood enemies' markets with counterfeit currency, sabotage trade routes, or incentivize the enemy's skilled workers to defect. Sun Tzu's world was one where economic strategy and military strategy were inseparable. The historical parallel to today's financial markets is striking. Just as warring states competed for limited territory and resources, investors compete in zero-sum or negative-sum games for returns. The stock you buy, someone else sells. The real estate you acquire, someone else doesn't. The wealth you accumulate represents economic territory captured in a competitive landscape. Sun Tzu observed that successful states shared common characteristics. They husbanded resources carefully. They struck only when conditions guaranteed success. They understood their competitive position relative to rivals, and they operated with superior information. These observations, born from economic necessity in a world of perpetual resource competition, form the foundation of what we might call strategic wealth theory, an approach to financial decision-making that treats markets as competitive ecosystems where survival and prosperity depend on strategic positioning rather than hope or luck. The genius of Sun Tzu was recognizing that the principles governing successful resource competition and warfare apply universally to any competitive domain where resources are finite and stakes are high. He didn't write a military manual that happens to have business applications. He wrote a manual for competitive resource acquisition that military leaders happen to use first. Let's now examine the philosophical architecture underlying Sun Tzu's approach and its direct translation to wealth creation. At the core of the art of war lies a sophisticated philosophy of competitive advantage rooted in three interconnected concepts: relative positioning, asymmetric advantage, and strategic timing. First, relative positioning. Sun Tzu writes, "Know the enemy and know yourself. In 100 battles, you will never be in peril." This isn't about self-awareness in a therapeutic sense. It's about accurate competitive assessment. In financial terms, this translates to understanding your position in the economic landscape relative to other actors. Most people approach investing and wealth building in absolute terms. They ask, "Is this a good investment?" Sun Tzu would ask, "Do I have an advantage in this investment that others lack?" The philosophy here is subtle but transformative. Wealth isn't created by participating in obvious opportunities. Everyone recognizes that's how you achieve average returns. Wealth is created by exploiting informational, psychological, or positional advantages others don't possess. Warren Buffett embodies this principle perfectly. He doesn't invest in the best companies. He invests where he has competitive advantage businesses. He understands better than others situations where his capital structure provides leverage others lack, or moments when his psychological disposition allows him to act while others panic. This brings us to the second concept, asymmetric advantage. Sun Tzu repeatedly emphasizes achieving maximum effect with minimum expenditure. Supreme excellence consists of breaking the enemy's resistance without fighting. In financial translation, generate returns that vastly exceed the risk and resources committed. The philosophy here challenges conventional financial wisdom. Traditional finance theory suggests returns correlate with risk. Higher returns require higher risk. But Sun Tzu's philosophy suggests the opposite. The best strategies are those that eliminate risk while maximizing reward. How? By changing the game itself. Consider venture capitalists. They don't accept market returns through diversified portfolios. They create asymmetric opportunities by providing not just capital, but strategic positioning, board seats, network access, operational expertise that transforms a company's trajectory. They manufacture advantage rather than hoping for it, or consider contrarian investors during market panics. When everyone sells in fear, valuations disconnect from fundamentals, creating asymmetric opportunities where downside risk is minimal. Prices already crashed, but upside potential is enormous. Inevitable recovery. The strategic insight is timing acting, when your psychological positioning gives you advantage others lack. The third concept is strategic timing, which Sun Tzu called shi, often translated as strategic advantage or positional power. He wrote, "The good fighters of old first put themselves beyond the possibility of defeat, and then waited for an opportunity of defeating the enemy." This philosophy directly contradicts modern financial culture's obsession with constant action. Social media, financial news, and trading platforms create an illusion that wealth comes from constant trading, frequent decisions, and immediate action. Sun Tzu's philosophy suggests the opposite. Positioning comes first, action comes second, and most of the time, the right action is no action. Charlie Munger famously said, "Investing is like baseball without called strikes. You can watch pitches forever until you see one you want." This is pure Sun Tzu. Establish invulnerable positioning, financial stability, knowledge, emotional control, then wait patiently for opportunities where advantage is overwhelming. The philosophical framework here is fundamentally different from conventional finance theory, which assumes efficient markets and rational actors. Sun Tzu's philosophy assumes competitive markets and imperfect actors, which is far more accurate to reality. Markets aren't efficient, they're competitive. The question isn't whether assets are correctly priced, but whether you have strategic advantage in acquiring them. This leads to a radical reframing of wealth creation. It's not about finding good investments. It's about creating conditions where you have structural advantages others don't. Not better information, that's often illegal, but better psychology, better positioning, better timing, better understanding of competitive dynamics. The philosophical sophistication of this approach is that it makes wealth creation a function of strategic thinking rather than luck. speculation, or hoping you're smarter than everyone else. You don't need to predict the future. You need to position yourself so multiple futures benefit you. Nassim Taleb calls anti-fragility, though Sun Tzu described it 2,500 years earlier. Now we enter perhaps the most powerful dimension of Sun Tzu's financial genius, his profound understanding of human psychology and how it creates exploitable patterns in competitive environments. Sun Tzu recognized that victory is determined as much by the psychological state of competitors as by material resources. In The Art of War, he writes extensively about deception, morale, fear, confidence, and the mental states that lead to fatal errors. These insights translate with devastating effectiveness to financial markets, where psychological factors drive most decision-making. Let's examine the key psychological principles and their financial applications. First, the principle of emotional discipline under pressure. Sun Tzu states, "The general who heeds my counsel and acts upon it will conquer. Let such a one be retained in command. The general who heeds not my counsel nor acts upon it will suffer defeats. Let such a one be dismissed." In modern terms, systematic decision-making beats emotional reaction. Markets are psychological battlegrounds where fortunes transfer from the emotionally reactive to the emotionally disciplined. During the 2008 financial crisis, certain investors lost everything, while others made billions, not because one group was smarter, but because one maintained psychological discipline while the other panicked. Behavioral economics has now scientifically validated what Sun Tzu understood intuitively. Humans are reliably irrational under stress. We panic at bottoms, euphoria buy at tops, hold losing positions hoping they recover, and sell winning positions too early to lock in gains. Every one of these behaviors is a psychological weakness that strategic investors exploit. Sun Tzu would recognize modern behavioral finance concepts like loss aversion, herd behavior, recency bias, and confirmation bias as tactical opportunities. When you understand these patterns, you can position yourself inversely to the crowd's predictable psychology. Second, the principle of information, asymmetry, and perception management. Sun Tzu devotes entire chapters to deception and the strategic use of information. All warfare is based on deception. Hence, when able to attack, we must seem unable. When using our forces, we must seem inactive. In financial markets, this translates to understanding that price doesn't reflect value. It reflects perception of value shaped by available information and collective psychology. Strategic investors understand that markets don't price assets correctly. They price them according to consensus perception, which is frequently wrong. The psychological insight is that perception creates reality in markets. During bubbles, overvaluation becomes self-reinforcing as rising prices attract more buyers. During crashes, undervaluation becomes self-reinforcing as falling prices trigger more selling. The strategic opportunity lies in maintaining independent psychological calibration when collective psychology detaches from fundamentals. Consider how elite investors approach information. They don't seek more information. Markets drown in data. They seek better interpretation of available information by understanding the psychology of other market participants. When everyone interprets news negatively, negative interpretations are priced in, creating opportunity from positive reinterpretation. Third, the principle of patience and selective engagement. Sun Tzu writes, "He will win who knows when to fight and when not to fight." Psychologically, this addresses one of the most destructive biases in finance, action bias, the compulsion to do something even when doing nothing is optimal. Modern portfolio theory and index investing accidentally stumbled onto this Sun Tzu principle. Most active trading destroys value because humans are psychologically compelled to act even when action is counterproductive. The average investor dramatically underperforms the market, not because they're stupid, but because their human psychology is maladapted to financial markets. The psychological discipline Sun Tzu advocates is recognizing that in competitive environments, you only engage when you have meaningful advantage. Most of the time, you don't. Most investment opportunities are neutrally priced or favor other participants with superior information, positioning, or psychology. The strategic approach is declining 99% of opportunities to focus resources on the 1% where you have edge. This requires extraordinary psychological discipline because our brains reward activity and punish inactivity. FOMO, Fear of missing out is a psychological vulnerability that transfers wealth from impulsive actors to patient strategists. Sun Tzu understood this 2,500 years before behavioral economists studied it in labs. Fourth, the principle of competitive psychology. Sun Tzu extensively discusses understanding the enemy's mental state, exploiting their weaknesses, and avoiding their strengths. If your opponent is of choleric temper, seek to irritate him. Pretend to be weak, that he may grow arrogant. In financial terms, this means understanding that your returns come from other participants' mistakes. You profit when others panic sell to you, when they euphoria buy from you, when they chase momentum into your exit, or when they exit in fear at your entry. This sounds cynical, but it's simply accurate. Markets are mechanisms for transferring wealth from those with inferior information, psychology or strategy, to those with superior information, psychology or strategy. Sun Tzu would recognize this as the fundamental nature of competitive resource allocation. The psychological sophistication is recognizing these patterns not to manipulate others, but to avoid being the one manipulated. When you understand the psychological dynamics that cause wealth transfer, you position yourself strategically rather than emotionally. The deepest psychological insight from Sun Tzu is perhaps this: victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win, translated financially. Winning investors establish psychological, informational, and positional advantages before deploying capital. Losing investors deploy capital hoping for advantage to materialize. This is why financial education rarely creates wealth. Knowledge without psychological discipline, strategic patience, and competitive positioning is just theory. Sun Tzu's genius was recognizing that victory is determined before engagement through psychological preparation, strategic positioning, and accurate competitive assessment. Now we arrive at the practical application: how to translate Sun Tzu's strategic principles into concrete financial strategies that build wealth in modern markets. Let's systematically apply his core doctrines to contemporary economic reality. Sun Tzu: an army may be likened to water. For just as flowing water avoids the heights and hastens to the lowlands, so an army avoids strength and strikes weakness. Financial application: don't compete in efficient markets where you have no edge. Seek inefficient markets where structural advantages exist. For most individuals, this means avoiding day trading large-cap stocks, highly efficient, professional-dominated, and focusing on less efficient domains, private businesses, real estate, in emerging markets, niche industries with knowledge barriers, or contrarian value investing in neglected sectors. The economic implication is profound. Returns in competitive markets approximate zero-sum after costs. You only generate excess returns where you have structural advantage, special knowledge, unique positioning, superior psychology, or contrarian timing. Sun Tzu would never enter a fair fight. Neither should you with capital. Practical example: instead of trading Tesla stock against algorithmic trading systems and insider-informed institutional investors, identify local real estate opportunities where your geographic knowledge provides edge, or invest in industries where your professional expertise gives you insight other investors lack. Sun Tzu: the value of time, that is, being a little ahead of your opponent, has counted for more than numerical superiority or strategic advantage. Financial application: concentration versus diversification. Traditional financial advice pushes diversification. Don't put all eggs in one basket. But Sun Tzu's principle suggests the opposite. Concentrate force at the decisive point. Diversification is defensive strategy for those without competitive advantage. Concentration is offensive strategy when you have edge. Warren Buffett concentrated 76% of Berkshire Hathaway's portfolio in just 5 stocks at one point. He wasn't being reckless. He was applying Sun Tzu's economy of force principle. When you have genuine edge, concentration maximizes returns. When you lack edge, diversification minimizes damage. The economic implication: identify where you have genuine competitive advantage. Then concentrate resources there, rather than dispersing them across domains where you have no edge. This requires honest self-assessment. Most people overestimate their advantages, which is why diversification protects them from their own overconfidence. Sun Tzu: the good fighters of old first put themselves beyond the possibility of defeat, and then waited for an opportunity of defeating the enemy. Financial application: build fortress balance sheets before seeking returns. This means eliminating high-interest debt, establishing emergency reserves, and creating income stability before deploying capital into investment opportunities. The economic logic is asymmetry. A 50% loss requires a 100% gain to recover. Avoiding losses is more important than achieving gains. This contradicts modern finance culture that emphasizes leverage, aggressive investing, and maximizing returns. Sun Tzu would view this as strategically insane seeking victory before establishing invulnerability. The wealthiest individuals establish financial invulnerability first, then deploy from positions of strength. Practical example: before investing $10,000 in the stock market, ensure you have zero high-interest debt, credit cards, personal loans, 3 to 6 months of emergency reserves, and stable income. This positioning means market volatility can't force you to sell at losses, providing strategic advantage over those without such positioning. Sun Tzu: if you know the enemy and know yourself, you need not fear the result of 100 battles. Financial application: develop deep expertise in specific domains, rather than superficial knowledge across many. The economic implication is that in information-age markets, competitive advantage comes from superior understanding, not superior information. Everyone has access to the same data. Few develop genuine expertise. This means specialization. Instead of investing across technology, healthcare, energy, and real estate with surface-level understanding, develop deep expertise in one domain: economic incentives, psychological patterns, and strategic positioning within that specific battlefield. Practical example: if you work in healthcare, develop deep investment expertise in healthcare companies, understanding regulatory dynamics, competitive positioning, and industry economics better than generalist investors. This creates edge. Or, if you're in technology, focus investment efforts there where your professional knowledge provides advantage. Sun Tzu: there are 5 essentials for victory. He will win who knows when to fight and when not to fight. Financial application: most wealth is created through patient capital, deployed at strategic moments rather than constant trading. The economic principle is that markets oscillate between overvaluation and undervaluation driven by collective psychology. Strategic wealth is built by deploying capital when others are fearful undervaluation and preserving capital when others are euphoric overvaluation. This requires psychological discipline to resist action bias. The strategic approach is maintaining dry powder-available capital for rare moments of genuine opportunity rather than constantly deploying into marginal situations. Practical example: during the March 2020 COVID crash, quality companies traded at 40 to 60% discounts to pre-crash valuations. Strategic investors who maintained cash reserves deployed capital at historic opportunities. Those fully invested had no capacity to act, regardless of opportunity quality. Sun Tzu would recognize this as superior strategic positioning. Sun Tzu: all warfare is based on deception. Financial application: recognize that market prices reflect consensus perception, which is frequently wrong. Strategic wealth is built through contrarian positioning, buying what others sell, selling what others buy, but only when fundamental analysis supports the contrarian view. The economic implication is that markets are not oracles revealing truth about value. They're mechanisms aggregating collective perception, which is subject to psychological biases, herding behavior, and emotional extremes. Strategic opportunity exists at the extremes when consensus is most wrong. Practical example: during 2021, growth stocks traded at historic valuations, while value stocks were neglected. Contrarian investors recognized that consensus had created opportunity by pricing growth at perfection and value with excessive pessimism. The subsequent 2022 reversal proved the contrarian positioning correct. Sun Tzu: there is no instance of a country having benefited from prolonged warfare. Financial application: minimize transaction costs, taxes, and fees. The economic principle is that in competitive markets, costs determine net returns. High-frequency trading, constant rebalancing, and excessive activity generate transaction costs and tax liabilities that destroy wealth. The strategic approach is low turnover, tax-efficient investing that minimizes wealth leakage. Buy-and-hold strategies aren't passive laziness, they're strategic efficiency, reducing costs that compound negatively over time. Practical example, an active trader generating 12% gross returns but incurring 3% in transaction costs and 3% in tax drag achieves 6% net returns. A strategic investor generating 10% gross returns with 0.5% costs and 1% tax drag achieves 8.5% net returns. Superior strategy beats superior market timing after costs. What emerges from applying Sun Tzu's principles to wealth creation is a coherent economic philosophy. Wealth isn't created through luck, speculation, or hope. It's created through strategic positioning, competitive advantage, psychological discipline, and selective engagement in opportunities where success is nearly certain before capital is deployed. This philosophy stands in stark contrast to conventional financial culture that emphasizes constant action, prediction, and maximization of returns. Sun Tzu would view conventional approaches as strategically naive, deploying resources without advantage, acting without positioning, and fighting battles that can't be won. The modern application of Sun Tzu's financial genius requires three things: brutal honesty about where you have genuine competitive advantage, psychological discipline to resist action bias and emotional decision-making, and strategic patience to wait for rare moments when conditions overwhelmingly favor success. This isn't get-rich-quick philosophy. It's build generational wealth strategy. And that's precisely why it's rarely discussed, because it requires qualities that social media, finance culture, actively discourages: patience, self-awareness, strategic thinking, and the humility to recognize that most opportunities don't favor you. Let's crystallize Sun Tzu's financial genius into actionable principles you can implement immediately. The overarching insight is this: wealth creation is a competitive strategic game, not a neutral economic process. Your financial success doesn't occur in isolation, it occurs in competition with other participants seeking the same resources. Understanding this transforms everything. Actionable principle: 1. Conduct strategic self-assessment. Before making any significant financial decision, honestly evaluate whether you have competitive advantage in that domain. Do you have superior information, positioning, psychology, or understanding? If not, don't engage. This single filter will prevent most financial mistakes. Actionable principle 2. Establish invulnerable positioning before seeking returns. Pay off high-interest debt, build emergency reserves, secure stable income. Only deploy capital from positions of strength where market volatility can't force reactive decisions. This isn't conservative, it's strategic. Actionable principle 3. Develop deep expertise in specific domains rather than superficial knowledge across many. Your returns will come from areas where you have genuine edge, not from diversifying across domains where you have none. Specialization creates advantage. Actionable principle 4. Practice strategic patience. Most of the time, the right action is no action. Maintain capital reserves for rare moments of genuine opportunity rather than constantly deploying into marginal situations. The discipline to wait is more valuable than the activity of constant engagement. Actionable principle 5. Understand that markets are psychological battlegrounds. Returns flow from others' emotional mistakes to your disciplined positioning. Study behavioral finance, not for academic interest, but for strategic advantage. When you understand the psychological patterns that cause wealth transfer, you position yourself as beneficiary rather than victim. Actionable principle 6. Minimize costs relentlessly. Transaction fees, tax inefficiency, and active trading costs are prolonged warfare that drains wealth. Strategic efficiency through low turnover, tax-optimized positioning, compounds advantage over time. Actionable principle 7. Think in decades, not days. Sun Tzu's strategies are about positioning for inevitable victory, not gambling on immediate gains. Build systems and positions that benefit from time and compounding, rather than requiring constant successful predictions. The reframing of our initial question reveals itself. Sun Tzu's art of war isn't about war at all, it's about strategic resource competition in environments where success requires advantage. That description applies perfectly to financial markets, making the art of war perhaps the most sophisticated financial strategy guide ever written. The reason no one talks about this, because strategic advantage erodes when widely known. The investors applying these principles benefit from others not applying them. Markets need emotional participants making reactive decisions, That's where strategic returns originate. But here's the paradox. Even knowing these principles, most people won't apply them. They require psychological discipline, patient execution, and honest self-assessment that contradict human nature and social conditioning. Knowledge doesn't equal implementation. Strategy without execution is merely philosophy. That's where your choice emerges. Will you continue approaching wealth building as you have been reacting emotionally, chasing returns, hoping for luck? Or will you apply 2,500 years of strategic wisdom to build genuine competitive advantages in your financial life? Sun Tzu already answered that question. Opportunities multiply as they are seized. Every strategic advantage you establish compounds into further advantages. Every emotional decision you avoid prevents compounding disadvantages. The choice, as always, determines the outcome. Now, I want to hear from you. Which of Sun Tzu's strategic principles resonates most with your financial situation? Are you currently fighting battles you can't win competing in domains where you have no edge? Or have you experienced the power of strategic positioning in your own wealth-building journey? Drop your thoughts in the comments below. And if you found genuine value in this exploration, if it shifted your perspective on wealth creation, share this video with someone who needs to hear it. Strategic knowledge compounds when shared with strategic thinkers. If you haven't subscribed to the Economic Philosopher yet, hit that subscribe button now. We're building a community of thinkers who understand that lasting wealth comes from philosophy, psychology, and strategic positioning, not from tips, tricks, or get-rich-quick schemes. Next week, we're diving into the hidden economic philosophy in Marcus Aurelius' Meditations, specifically how Stoic principles create psychological advantages in market volatility. You won't want to miss it. Until then, position strategically, act decisively, and build wealth with intention. This has been the Economic Philosopher, where ancient wisdom meets modern wealth. I'll see you in the next deep dive.